Welcome back, folks. It's Mark Montford here for the FEX Insights Podcast, Episode 2. We are diving into the news. We've got a special guest from a data provider, as well as deep dives into things like better measures than TVL for real-world asset tokenization. See you inside. And in the news this week for the 30th of May, 2025, first of all, we had US banks edge into the crypto amid regulatory easing. So major US banks, including JP Morgan, Bank of America, and Morgan Stanley, are cautiously exploring crypto ventures such as spot trading, custody services, and stablecoin issuance. This shift follows the Trump's administration rollback of previous restrictions, though these banks will still seek clearer regulatory guidelines before fully committing. You can see the Reuters article here. Another big thing in the news this week was that Circle targets a $6.7 billion valuation in their upcoming IPO. So Circle Internet, the issuer of the USDC stablecoin, plans to go public on the NYSE, the New York Stock Exchange, aiming for a valuation of up to $6.71 billion. Now, this IPO is going to be underwritten by major providers like JP Morgan, Goldman Sachs. This reflects growing investor confidence in crypto under the current US administration. So check out that article here. Staying over in the US, the Trump administration advocates for Bitcoin in the US-China rivalry. So Vice President J.D. Vance emphasized Bitcoin's strategic importance in countering China's crypto bans, advocating for the US to embrace digital assets. This aligns with President Trump's executive order to establish a strategic Bitcoin reserve, signaling strong governmental support for cryptocurrency adoption. And we highlighted last week that it's not just the federal government, but also state governments as well, with Texas also looking to create a strategic Bitcoin reserve. Now over into corporate treasury movement and market impact. We see Bitcoin surge to record highs during the week amid institutional flows. So Bitcoin reached an all-time high of $111,000 by significant institutional investments and corporate treasury allocations. So that's what was driving it, not just retail. Public companies are increasingly adopting Bitcoin as a reserve asset, indicating a shift in traditional financial strategies. More on this in this article. Another major news item this week, and we haven't heard from them for a little while, but GameStop came roaring back with a $513 million investment in Bitcoin, trying to become like Strategy or MicroStrategy, as you will know from Michael Saylor's change of what the company does there. So GameStop announced that the purchase of approximately $513 million worth of Bitcoin, acquiring 4,710 BTC. This is part of its strategic shift into crypto. So really interesting stuff. This aims to diversify its financial strategy and rejuvenate investor interest. Will it work? We shall wait and see. Finally, Trump Media Group plans a $2.5 billion Bitcoin treasury. So Trump's Media and Technology Group revealed plans for a $2.5 billion worth of treasury to establish this Bitcoin treasury that they've got. It's a strong endorsement of digital assets, aiming to position the US as a leader in the crypto space. Now over to DeFi tokenization and infrastructure developments. The first bit of news is that Centaura forms a bridge with institutions and DeFi. So DeFi firms Into the Block and Trident Digital have merged to create Centaura. This is a platform designed to offer compliant DeFi solutions for institutional investors. This is backed by $25 million in funding, and they aim to provide tools for yield strategies, compliance, and risk management, according to this CoinDesk article. And then finally in the news for this week, the US crypto funds management space is seeing $7.5 billion worth of inflows in 2025 so far. US-backed crypto asset investments have attracted over $7.5 billion in 2025, with a fifth consecutive week of net positive inflows. This is signaling institutional demand for digital assets. Check out this article for more. That's it for the news this week, folks, and head on over to the next part where we get to interview a guest from Kaiko. They're a data provider and doing some great things in the world of crypto. All right, folks, for episode 2's guest, we have Adam from Kaiko, and we're going to dive into what they do as a leading index and data provider in the crypto space. All right, folks, welcome back. And this is the second episode of the FEX Insights podcast. And we are here with a special guest from Kaiko. Adam, thanks for joining us all the way from Ireland.
Thanks so much for having me, and thanks for staying up late just to get me on.
Yeah, no problem. Folks, you will be seeing that there is some editing going on here, but we've got a few questions for you that I'll just dive straight into, and please feel free to get into the detail here. But for those that haven't heard of Kaiko, how do you explain what you do now without using the word API?
Yeah, I think I'm not too technical, so you've got the right person here to jump into this. But in a simple sense, we kind of do three main things. We're data analytics and indices. So on the data side of things, we've been collecting crypto market data for just over a decade now. So it makes us one of the oldest data providers. In a simple sense, what that means is we're plugged into all the exchanges. I think over 100, if you go back, from 2014, 2015 onwards. So currently, you know, over 100, access to over 100 different exchanges, the data on those exchanges, trade volume, spreads, liquidity, everything. So that enables our analytics arm, where we kind of do some derived data things, where we look at, value at risk, we look at implied volatilities, all that other good stuff. And then that also feeds into our other business, Kaiko Indices, where we use our, plethora of data to create robust indexes, robust rates, and to vet exchanges kind of carefully on a standard we're creating. So in a simple sense, hopefully that's simple sense. That's what Kaiko does.
Very good. Now, you're often referred to as the Bloomberg of crypto. Is that fair? And what's different about the way you think about data?
I think in the sense that we're we're both enterprise grade solutions for sure, but kind of the similarities can probably stop there. I think Bloomberg's obviously a dashboard and interface, one of the most well known things around the world. If you see the orange and blue on a movie, you kind of automatically know what it is on the computer screen. But what we are is we're kind of crucial infrastructure queue for service for kind of a new space. I don't know if we'll ever go down the route of what a Bloomberg is, but we often definitely service the same clients and have the same kind of role in enabling kind of institutional solutions and decision makers.
That's great. Let's get inside the data machine. How do you ensure data integrity in such a fragmented and fast-moving market?
Yeah, it's tough. I think when I first joined Kaiko, I'd seen the data, I'd seen their kind of output, and I assumed, well, must be easy. I can't wait to kind of get involved and use this. And then you kind of see it's a little trickier. There's a lot of going on behind the works with Kaiko. We're a global company. We've got people in New York, London, Paris, Singapore, and then you've got some remote workers working 24/7 to make sure that we've got support. If a client spots an outlier, if there's an issue with data, with some data or with a product, we're on that. It's a 24/7, 365 kind of machine. And we ensure those kind of things through like multi-layered quality control. On the more kind of qualitative side, which I touched on earlier, we kind of do other things on indices where we do exchange rankings and vettings. So our latest exchange ranking will come out now. So that relies on the data, relies on our tech team to look at the technology and the data quality, relies on the research side, which I'm on, to look at liquidity and volumes, and then also our legal side to look at governance and business. So it's a multifaceted approach to, as you say, a fragmented and kind of sometimes hard to understand the industry.
Yeah, it really is fast moving and a lot of nuance in the different areas there. Now, getting into more of things that we typically see with data, but what's a data quality issue in crypto that you think most people underestimate?
Yeah, there's a few. I think one that I underestimated was there's a lack of standardization across different platforms. So that happens that kind of causes issues in twofold. If you're looking at DeFi protocols or if you're looking at blockchain, how they output data and how they share things, it can be very different from chain to chain, from protocol to protocol. That can make consuming and cleaning the data, very difficult because you can't apply what you might apply on Ethereum to what you might apply on a DEX on Solana. So it just adds an extra layer of kind of difficulty there. And that similarly happens in the kind of centralized space as well. If you look at perps products, let's say, the contract size, contract units are completely different from exchange to exchange. Even on some exchanges, they're different. So if you're trying to normalize everything in US dollar volume, you have to have a different kind of calculation for product to product from exchange to exchange. It's not like in kind of traditional space where you might have some standardization around the CME products. A Bitcoin CME future is like 5 Bitcoin or whatever it is, and it's quote asset. It's quoted in US dollars. It's not the same in crypto, so it adds a lot of difficulty in standardizing data and comparing across platforms or across products.
Yeah, as they say, devil's always in the detail there. Now, Kaiko covers both centralized and decentralized exchanges. What are the hardest parts about pulling reliable data?
Yeah, I think what we touched on there with the kind of different standardization, but also with some DeFi, like, if you look at Solana, which we added recently, the sheer size of that made it kind of a really enormous task. I think it's got a lot of bad rap in the last year for like meme coin mania and all those other things. But that makes the battle tested chain. It means it can do a lot of things. On our end, it means there's a lot of data. If people are trying to onboard that, I think I remember chatting with the product manager on that, and he was talking about petabytes of data and how much effort it was taking to kind of consume that, sift through it, and figure out where the useful stuff is. So that's the sheer size of some things. There's so much happening on chain on some chains, which is like, great and also creates difficulties, but it's good to see. So it's a solution. It's a problem I think we don't mind finding a solution to, but it's definitely can make the process a little bit more considered, a little bit slower.
Yeah, definitely need data expertise there, because otherwise it can be a bit of a double-edged sword. Now let's get over to use cases and trends. What would you say are the most interesting users of your data today, and how are they using it?
Yeah, I think the use cases and trends, here's what's interesting. If we go back a year when kind of the ETF stuff was happening in America and a little bit before that, kind of late 2023, we work with a lot of regulators. We work with regulators in Europe, regulators in the US. And I would have said then maybe for the audience that those are the kind of most interesting clients we have. But I think it's kind of changing a bit since that approval happened. There's other things I'm looking towards. So we work with we work with funds, we work with central banks as well. I think some of the more interesting stuff though now is happening in tokenization. So we're working with the Canton network, which is kind of institutional focused blockchain network for tokenization of real world assets, where it's kind of privacy first, but you have options to do other things. That's something I find very interesting currently, and how data can bring efficiency and improve the workflow on chain. I think we're kind of at Kaiko making a bet that, real world asset tokenization stuff is going to really be the kind of the real kicker for crypto in the coming years. So I'd say tokenization. Other than that, I think there's some really interesting index products happening out there. We're working closely with asset managers across the US and Europe to bring new solutions to investors. It's not just about spot products. You've got Bitcoin, you've got ETH, but we're slowly going to get there where, people are more comfortable with getting a basket product on these things. It might still be heavily weighted to Bitcoin, but, you've got a little bit of kind of spice in your portfolio there where you might get some Solana and some XRP. So those are kind of some interesting areas I see: tokenization, kind of advancement of funds and how we design those things. But all of our clients are interested. So
Absolutely. What kind of trends are you seeing from institutions? What signals stand out from your vantage point?
I mean, the main signal I was watching recently was quite the ETF flows throughout May, and super interesting. I think BlackRock's IBIT is up over 72 billion now. That kind of buying demand is super interesting to watch, and we're seeing it translate into kind of other couple of companies. Obviously, Michael Saylor's strategy with like hoovering up Bitcoin for the last 4 or 5 years now is interesting. It's kind of gone into another area now. It's kind of got it's amorphous. It's like this kind of a SPAC sort of element to it, where there's other companies kind of rolling up just to buy Bitcoin or Solana and Ethereum. Interesting, I think, is a way to put it. I don't know how sustainable that model is long term. You've got kind of medical device companies saying they're going to buy 500 million worth of Solana, and suddenly their stock is up 20%. So that's kind of what I'm seeing from the institutional side in the market. What signals I would watch more internally at Kaiko, I guess, from the underlying data. Heading into the summer, I think typically we expect to see things kind of slow down. I mean, I know you're heading into the winter. You know, I'm grappling with the heat here in Europe, but heading into the summer months, I think what we usually expect to see about May is people are kind of like cool down their positions, slow down. The saying is sell in May and go away to say Ledger's Day or whatever. So sometime around October, we should see things pick up. But this year, with the kind of unique macro stuff that's happening in the US with the new administration in Washington, we're seeing potential for like, an uptick in volatility over the summer. So a signal I'm watching would be kind of our IV smile. Typically, we'd expect it to be a bit more flat, like not as skewed as it is right now. And there's a potential for some kind of uptick in volatility around June and July, which kind of ties in with the next Fed meeting and the U.S. president's deadline on tariffs for other countries. So that's something I'm watching. I think a lot of Wall Street are watching as well, but they've got a new acronym for it. So I think it's Trump always pulls out or something like that. So we'll see. Maybe there'll be no tariffs and maybe it's nothing, but it's something I'm keeping an eye on and we're watching.
Yeah, certainly. And as you mentioned, the Trump tariffs, I think it is a good idea to go over to like macro side of things and also regulation. Now you've expanded globally over at Kaiko. How do regulatory developments in, say, the US, Europe, or Asia affect your business and your clients?
Yeah, I think that like crypto folks in the past might have, when I first got into crypto 7 or 8 years ago, been a little bit hesitant of regulation. They thought this is kind of like Big Brother coming in to kind of suffocate the kind of area, the business and the enterprise and all of this. But I think we welcome it. We work with regulators. We are kind of a crucial service and cog in that system. So with the kind of innovations of like the introductions of Mika and other things, DORA as well in the EU, that brings in the need for a data provider like us. We're SOC 2 compliant, SOC 2 Type 2 compliant, all of these things. And we work with regulators. We're benchmark. We got a BMR approval in the UK. We're like, the only regulatory approval for index and rate providers. So we're set up for that. We're built with that in mind. As it's coming online across the world in the US and Europe and in APAC, we're ready to work with our clients on it who need to come online. But a lot of them already are. A lot of the clients that we work with are institutional grade. So they've done that along with us, where they've kind of set up with that stuff in mind. When I first got on crypto the same 7 or 8 years ago, it was like regulation, all that stuff was to the back. Now it's kind of it's happening in tandem with everything else. It's not build and then figure it out. It's build within the kind of like framework that makes sense, because that's how you're going to get customers and that's how you're going to get people on board. So yeah, I think all in all, put it like kind of neatly, regulation grows the demand for solutions like ours, and we're here to kind of help others with that.
It's a great way to put it. What role do you see that data plays in building trust and transparency, especially as the space matures?
Yeah, I think just having reliable data is always going to help build better products. It's difficult to get an accurate price for Bitcoin across exchanges, across platforms, because they're a fragmented market. Having accurate pricing, less headlines, basically. If you've got reliable, steady data, you're not going to have, one trader bought Bitcoin for this or tried to sell Bitcoin and they lost 20K. That doesn't happen in a mature market where you've got solid data solutions across exchanges and across platforms. So I think it just brings kind of maturity and reliability to what people are seeing, what they're doing. It was the Wild West 10 years ago in crypto. It's not anymore. And that's because of providers like ourselves, which work with exchanges and work with users. So when you're buying Bitcoin, you're buying Bitcoin at the right price. You're buying Bitcoin at an accurate price. The liquidity is there. So yeah, that's another thing. I think liquidity as well, like looking at volumes and activity across exchanges, spotting kind of working as well in tandem with market surveyor kind of tools like Trillium, who's a partner of ours, making sure there's no illicit activity happening on these exchanges. So data is crucial for that kind of thing as well.
Fantastic. And let's get to a part where we kind of look forward a little bit more. If you could magically get perfect data on one part of the crypto or tokenization markets tomorrow, what would it be?
I think something that there would be a big need for is probably the ETF flows. I see a lot of people online. I see a lot of this is probably maybe retail focused, but also I think institutions care. Is that the BlackRock ETF settles sort of a day later than the other ones, so you're seeing flows on Monday evening that were Friday. People don't really follow what the flows are and where they're coming from. The basis bit there's a lot of crypto is inherently built with kind of fighting back against the system. And for a lot of people, Bitcoin, um, I think that they don't trust that system. So I think if we could get reliable ETF data on chain or tokenize it or have it that people can really see and track where they're coming from, see wallets. I know there's a big debate about wallets this week and whether MicroStrategy should share theirs. Um, I think that would be a good thing, more transparency around that builds more trust, as we said. So I think ETF flows, institutional flows. Obviously, if you're a hedge fund, you don't want people to know where you're moving your money. But if you're a public company that's adding 5,000 Bitcoin to your balance sheet, I don't know. I don't see the issue with sharing the addresses there. Security wise, I think it's still, you'd have a better chance of winning the lottery than guessing what their private keys are just from knowing what their address is. So I think that would be my main magic wand wish would be to make that data more accessible.
It is a funny market when, you've got people that, and obviously we need commercial confidentiality, but it's an industry where people want transparency on the one hand, but don't want to practice it on the other. So speaking of, moving forward, how's Kaiko preparing for the next wave, whether it's RWAs, stablecoin adoption, institutional on-ramps, etc.?
Yeah, so obviously bringing it back to the pricing thing with the advent of tokenization of real world assets going on chain, that's where we come in as again, accurate pricing, accurate data to improve efficiency and kind of workflows on chain. If you want to transact on chain, you need to be able to still speak with off chain kind of systems. That's where we come in, kind of translating that data, helping institutions get comfortable being on chain. We work with them already off chain. So that's kind of probably the main area, I think, tokenization. Stablecoins, we work a little bit with some stablecoin providers. We chat with our sales team sometimes about how we can do more with stablecoins. I think certainly if you're a stablecoin project and you're looking at LATAM or you're looking at expanding into APAC or anywhere else, emerging markets somewhere, what we do is we have data there on those places. We know what people are trading on exchanges. And, around there we can help if there's a demand for your product and say, well, you've got X or Y stablecoin and it's actually traded a lot down here. You should go to the source there and kind of, have a solution. So we can help with those kind of things as well. But I think tokenization is probably the cool thing right now that we're all, well, not right now. We've been excited about it for 5 or 6 years or longer even. I think we had a team retreat last week and we went over a pitch deck for Kaiko from 6 or 7 years ago. And it was talking about, security tokens and tokenization. And it's coming to fruition now. It's still probably going to slowly happen because that's how things work in the kind of tech industry and the kind of finance industry with tech changes, because these firms, worth trillions of dollars. They can't just change overnight, but we're there to kind of make them comfortable with that stuff.
Fantastic. And we'll round out with a bit of a fun one. But what's a myth about crypto data that you'd love to debunk?
Yeah, I think explaining to my friends or family, and they think crypto, it's all on chain, it's all open source. It's not that easy to get access to. It's a little harder than that. They think, it's just, you check the ledger, check the chain. Not a thing, I think it's oversimplified. It's not as easy as it looks. And what our ops and what our engineering team do is that's the real magic. Simplifying that so people can digest it simply.
Sounds like a bit of an iceberg there, and people just see the top. But how do people get in touch if they want to learn more about Kaiko, what you guys do, the services you provide?
Yeah, I mean, Kaiko.com is probably the place to go there. We're on Twitter as well, Kaiko Data, and LinkedIn. Our newsletters go out on Mondays every week. We've recently launched a premium newsletter, so that you can get that at kaikoresearch.com. I think if you search research.kaiko.com. And we've got an index in focus report that I launched myself in January. That goes out every second week on Thursdays. So yeah, I mean, we've got plenty of content. We've got the odd webinar and analyst call to kind of go through things too. So if you get to kaiko.com, you can check it all out there.
Fantastic. I'm sure we'll dive more into the details in future episodes. But for now, Adam, thank you so much.
Thanks so much for having me, Mark.
There you have it, folks. That was the first part. We'll bring Kaiko back because there's certainly some cool research stuff that they do. I'll dive into some more of the different topics that we'll need to really understand how to actually bring blockchain technology and data into the institutional finance space, how it helps overall in terms of capital market efficiency, and just more of the nuances that you just don't get to see at a surface level. We'll certainly dive into that with Kaiko. So stay tuned for the next episode. Welcome back, folks, and this is the Education Deep Dive that I do each week with my colleague Arturo, who only has to be here because I put it in his diary. Arturo, thank you for joining us.
Thank you for having me.
Alrighty, so look, during the week, and it was great that we got to share this, we shared some insights from a risk.net webinar, which was really interesting because it's the world that we used to work in. We met in London working at an investment bank. Thank you, Canaccord. You've done a whole lot of other stuff there working in Europe, and I've done stuff here. But these things like clearing houses, like investment banks, all the types of the groups that you would traditionally associate with institutional finance. So they did a talk, and it was all about the state of the market and digital asset derivatives. Now, when you think about just first of all, having come from that space, and we've seen what blockchain can do you think that, actually, I know what you think, but I want to hear it for the crowd. What do you think the audience needs to kind of know at a very high level from blockchain that's never dealt with traditional finance?
So people from blockchain that have never dealt with traditional finance. Okay. So
big topic.
Yeah. I'll mention something that happened 2 days ago. I was on a panel for Swift.
What's
Swift is it's effectively an interbank or interfinancial institution messaging system. So when you send a transfer, for example, that is a cross-border transfer, then you tell your bank you want to send money from A to B. The bank then creates a Swift message and then sends it to the receiving bank, and then both banks know that this is supposed to happen. So it's a message, it's an intention that's being communicated, and then the execution of that transfer happens somehow. And that's where the TradFi part is really interesting, right? Because banks, the entire financial system is kind of run on COBOL, Excel, email, and XML. And all of these are technologies that are, before the 2000s, right?
Yeah, your grandpa probably coded.
Correct. So it was actually really interesting because you listen to all of the banks talking about how much money they spend, how difficult it is to implement this XML-based messaging system. And it's XML because it was this ISO 222. It has its origins in the early 2000s, which was when XML was used, right? And it's taken from then until now to kind of get people to implement, but they're still out there.
It's like 20 years.
Yeah, and that's just at the messaging layer, right? So they're standardizing the messaging so that the banks can tell each other, this is what we're supposed to be doing. But then the back end needs to execute it, and all of these different back ends are completely fragmented. So they were built in the 70s sometimes, completely different architectures. Often, sure, in the bigger scheme of things, what they do is that they do debits and credits, but they do so differently. And the problem then is that even if you have the standardized messaging layer, you have a very, very non-standardized way of actually executing the transactions, which means that you have the fragmentation that leads to more exceptions than standard scenarios. And that's what makes traditional finance really, really tricky. Right?
Slope.
We're using really old legacy systems, and things go wrong, and it takes time to correct them, and it's usually people that are correcting them and so forth. So it is definitely not a blockchain where you have an ERC20 and you submit this intent to transact, that message is compressed into the actual execution, so you almost instantly know if it has settled or not, and you don't need to reconcile in the same way as you do in traditional finance, because in traditional finance you'll spend millions of dollars both in technology and headcount just for reconciliation.
It's interesting that that's the world that runs the global capital financial markets, and yet the interesting things there is that initially people thought, okay, we're going to build a brand new system, we're going to get everyone from TradFi over into blockchain. Then they realized that that's not going to work. It's more about bringing blockchain technology into the world of traditional finance. But even that is not enough, because if you just think that, and it's as simple as that, you're going to have very immature conversations with folks. And we've seen that kind of stuff. But what you need is the way that the traditional finances work. It's not a problem of what they've set up. We need standards. We need these rules. We need like the way things are set up, but they're running, to your point, on old tech. So we need traditional finances. This is what the webinar guys, there was Andy from Standard Chartered there, Global Head of Prime Brokerage. There was a guy from LCH Digital Asset. So they're doing stuff in, they're a clearinghouse. They're doing stuff in the digital asset space. And they spoke about needing to bring traditional standards and norms into how blockchain comes into traditional finance. It's not enough to just bring it in. What do you think about that?
I think it makes sense. I mean, it's very nuanced, and I think that it's important to make a clear separation between crypto and blockchain. But standards are important, and you don't want to reinvent all of the different standards, because at the end of the day, financial stacks they're very, very they have multiple layers, right? You have risk management systems, you have execution systems, you have booking systems, you have all of these different things that don't all need to be or should not be on a blockchain.
Yep.
Right. So what you want to see is effectively ledgers and settlement mechanisms on a blockchain, but that are also compatible from API or technology or messaging layer with the existing systems, because otherwise you have to rewrite absolutely everything, which will never work. Nobody wants that, and nobody should do that for that matter.
I'm working on a healthcare project, and we work in the AI space as well, folks. And you know about this, that this healthcare place, they've got a lot of fragmented different systems, and thought, oh, the CRM doesn't work, let's overhaul it. And that's a good initial thing to think about, but the time it takes and the money and the resources that it would take to do that versus having something that sits in the middle that can actually connect and talk to that old system, that can talk to newer systems and bring all the information together, and then having that kind of like a dashboard or whatever you will in the middle that is able to converse. But my point with all of that was just that it's really needing to understand those systems and maybe like have a best of both worlds, something that can both talk to the modern systems that blockchain provides, but also is able to talk to the APIs as well. Something else that the guys raised was that the need for digital assets, the market, it's maturing, no doubt, that's fine. But the biggest problem is that they said unless you've got a market that it's not just spot, but it's also futures and options, you don't really have a market. And blockchain crypto doesn't really have that. Like options are only about 5% of the market. And why do they need that? Because if you're traditional finance, you don't just bet on Bitcoin. That's a very immature kind of thing. You hedge. You want to gain exposure safely. You want derivatives products. What do you think about all of that, what they said?
Yeah, I mean, it makes a ton of sense. It again, difference between crypto being an asset class versus blockchain being a tech stack, right? You don't call NASDAQ an asset class.
Yep.
It's an execution layer, right? So from the asset class perspective, i.e., from the investment perspective, then the derivatives market has grown to become what it is because of utility, right? What you're doing in a financial market is that you're transferring risk back and forth, and risk of different forms, right? So you can see, for example, that you have a very deep options market for S&P as an example, because pension funds and larger institutions, they usually hedge their exposures, right? And then they'll buy, for example, a 5-year put or something like that. And they need to roll these exposures constantly. So then you have market makers, you have hedge funds, you have banks that will sell these options, but then they need to hedge themselves as well. So they'll hedge with shorter maturities or with other things that are in the market. So all of a sudden you start seeing that you have this creation of a market with a lot of richness, with a lot of different instruments, because these derivatives have very varied types of risks. But again, it comes from certain utilities where you have very big participants that have needs. They will spend money. They will continue rolling programs. And we don't have that yet in crypto, right? So the options market in crypto has effectively, well, if we talk about off-chain markets,
Sure.
right?
Yeah.
Has come from innovation, people trying to figure out, well, how do we use this new technology to replicate these financial products? And then speculation has really been a big part. But now that you see bigger participants, especially investment banks, that start playing in the ETF market where they actually have to trade the underlying assets. And when you see that there are they're bigger, more sophisticated players that start transferring and speculating on more pointed risks, let's put it that way, then I think that you will start to see much more maturity in these derivative markets, because they're important. Without derivatives, you just don't have the same level of liquidity.
It's really interesting because there's a bit of an irony there where folks don't quite realize in the blockchain space, because they've never been exposed to traditional finance, but they don't quite realize just how valuable it is they are. Even if they, most of the people that I think would watch this podcast are from that traditional finance side of things. And we're targeting that, it's on LinkedIn, it's on these websites and distribution channels that are there. But for folks that are from the blockchain side coming into this, the tech that you've been building and making monkey JPEGs with and all that is actually quite a useful thing for exactly what you've described there, because without that, it is inefficient. And to your point, it's not going to be used for everything. We'll be very pragmatic with this kind of stuff. But it's just interesting that they need to realize just how powerful it is.
I remember when I was at RBS, I have quite vivid memories of looking at emerging market structures linked to emerging market risk. Mm-hmm. And we were running a structured products business, so it was all about derivatives. And when we wanted to sell an option on a South Asian stock, for example, or something like that, mm-hmm. Southeast Asian stock, something that was not only illiquid at the delta level or at the actual equity level, but didn't have a derivative, then it was basically impossible.
Yeah. Right.
And I think that, I just want to highlight the importance of these complex, the utility of these complex derivatives. During the GFC in 2008, there were certain markets that did not allow for shorting.
Okay.
All right, you couldn't short sell equities. And the intention of that was to stabilize the markets, because they didn't want people to just indiscriminately sell. The problem was that they actually did the opposite, because if you then all of a sudden are not able to sell when you need, then you just don't get in. And if you don't, and there are two things that make prices go down, right? One of them is short sellers, but more importantly, it's the lack of buyers. So if I know that I can't execute certain strategies, or that I maybe have multiple different books whereby it could be seen that I am short selling when I'm actually not, because I haven't pooled those assets, then I'm encumbered and I can't get into that stock, right? So the point is that liquidity is really driven by richness in the derivatives market and things that you can do with these assets.
It's that depth that if it's not there, then you're not going to have a market. You need these things. People complain from a retail perspective, and we just mentioned GameStop in the news earlier. And it's funny because the first time a lot of folks heard of GameStop as a stock, not just a company that you could go to.
I like the stock.
I like the stock. Famous for the movie that even came out from it. But people thought that short selling is bad. Why would you short sell and stuff? It's like, guys, there's a reason for this. The reason why you have your pension funds, your superannuation, depending on where you are, is because companies can do this kind of stuff. Now, what's interesting is that going back to the investor side of things, on this risk.net webinar, and I have my summary here that you can see, folks, but I asked the question, and it was late at night. It was 11 p.m. here, till midnight that it was. It was great to watch and online, and very cool that they allowed people like me calling all the way, miles away in Sydney. But I asked the question about if they think, the panelists, TradFi, traditional finance, is more motivated by efficiency gains, like we're talking about with technology, or is it just capital formation? And Andy Ross, he said that while clients often focus on capital formation, Standard Chartered is also interested in developing new markets, applying their emerging markets expertise to digital assets and bringing in that expertise. They're also seeking that sweet spot, balancing client demand with long-term infrastructure development. What are your thoughts on that?
I think that that people see what is, let's just say that people see what is shown to them, right? So in a new market or a new technology, a new thing that you're creating, it can be applied in many different ways, right? And in this case, we're talking about either capital formation or making better products, right? Now, if what people are doing is focusing on the capital formation, and that's what they show their customers, and obviously that's what the customers are going to be seeing, and that's what they're going to be thinking about, and that's where the focus is going to lie, right? And in this case, I think that many institutions have done a few different things, but at the end of the day, most of the profits have actually come from participating in crypto markets because they're very volatile, and they're very liquid as well, so they're actually perfect for trading. And there's also been this idea that if you list an asset in a more efficient market, then liquidity will come to it. I think that notion is slowly disappearing. It should disappear quickly because that's not how things work, right? We on the other hand, we see a lot of customers that are actually not at the very top end of town. But it's many customers that, for example, they will have financing strategies for real world assets, solar panels, for example, right? And these are businesses that are, they're not multinationals, but they're not tiny businesses, and they have focused on that workflow, but they have not focused at all on how to make the financial engineering efficient so that they can actually raise capital from the right places. Now, in that instance, blockchain is really making a big difference, because what you're selling is the ability to create a better financial product using the technology, as opposed to hoping that when you create that financial product, automatically it's going to get liquidity from customers that you don't know. Right. So again, I think that's just because many participants are seeing one thing doesn't mean that there isn't interest from the market in other places. It's just that that's not really being seen. But as soon as you show it to them, they're like, wow, that's amazing. I don't care about blockchain, but I just want access to easier forms of capital from customers, or it's easier for them to access customers that they already know, because the financial engineering is simpler to execute on.
Yeah, I think that it's absolutely interesting. I guess the final thing that we have for this kind of education / deep dive that I want to look at is a topic that I would say it's a blessing in disguise that it's come up. And what I mean is how real world asset, RWA, tokenization projects are measured by TVL as the main kind of glorified metric there. And I say it's a blessing in disguise because we would not be complaining about this with our friends at places like Red Belly if Red Belly's TVL was translating to like, oh, look at all this like great kind of price action, or people weren't complaining about the lack of it for certain things and peering on aggregators one versus not appearing on the other. We would not be complaining if all things were rosy, but we do complain, and it forced us to look at how TVL is just a bad metric for measuring things. And speaking of better metrics, and we'll probably dive into this more, but what do you think about what others are looking at? So I've spoken to people that look at things like workflow penetration, the on-chain enforceability of things and how it ties into actual legal contracts, operational usage, real user adoption and the like. But this whole thing stemming from the problem of TVL being the only metric that investors at the moment are looking at, because that's what's being shown as you described. Thoughts?
Look, I think that there are many very, very smart people in crypto, and then there are others that love sound bites. And that's just not only in crypto, obviously. It's everywhere, right? So I've read very good pieces about why TVL is important, and specifically TVL linked to liquidity pools. And important from the point of view of why it's good for the blockchain, right? So a blockchain is nothing more than a business that generates profit of transactions, right? It's just that these are not only trading transactions, but it's usage of the network, right? So if you have a pure crypto environment, right, where you lock in these assets into a pool, then the pool through an AMM, for example, trades these things, and it generates activity, right? So that's actually good. Number goes up because it's, the chain is effectively generating revenue. Now, I think that only really applies when you're looking at blockchain native assets, right? Because if you were to tokenize, depending on how you do it, of course, the NASDAQ has, a few $1 trillion, I think, or whatever it is. Like, it's a massive number.
Yeah.
Bigger than many crypto protocols, or most, every crypto protocol, probably. But in the way that TVL is currently calculated by many of these dashboards, that would probably be a TVL of 0.
Yep.
Right? Because there's so much that happens that is off-chain.
Exactly.
And these guys just want to measure things that are on-chain for good reason.
Yeah.
Right? Because if you don't measure things that are on-chain, then all of a sudden you need to have good legal structures so that there's recourse and yada, 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 right? But the point is that you can't look at the number you can't look at the TVL number and judge everything on the back of it, because it makes absolutely no sense.
It's like I saw a good one here where it's kind of like measuring how good a house is or how valuable a house is by looking at the mailbox.
Yeah.
It's like it doesn't. There's multiple factors. There's and as we described there, what you would do for a house, you'd look at the suburb, its surroundings, what's inside it. It's not just the surface level. What's underground as well. Noise, all this kind of stuff like plays into it.
Look, when it comes to the earlier, more naive RWAs, I think that the TVL, let's call it measure, has been important so that you put less emphasis on RWAs and more emphasis on crypto native things.
Right.
Because the crypto native things, they're just easier to trace. You can see what is actually happening, whereas in RWAs you can't.
Yeah.
Because a lot of that is off-chain,
Yep.
right? So in the early days, and probably even still today, you'll have a bunch of people that say, I've tokenized, $300 billion worth of this, or I have that, and so forth. And when you start looking into it, like, there are 0 legals. So that number is
Doesn't mean
effectively a made-up number.
Yeah.
So stay away from that, right?
Yeah.
So I think that these crypto dashboards are actually quite healthy from that point of view, but you need to understand what you're looking at. There are other projects where there is proper legal work on the back of it, and there is actual TVL in the sense that this token gives you the right to X amount of value, and that value is off-chain and it's secured legally if people want to accept that, right? But that's where the TVL for RWAs is, doesn't mean that much.
It's interesting because it is one metric. Like, people could do 4 out of 5 of the things, leaving TVL last, and still be a far more valuable kind of thing that people, whether retail or other investors, should look at. and make their own decisions with your financial advisor, not financial advice. But they would want to, I would say, look at that more because it's got all these other things going on. And maybe TVL's the last. But even if TVL was the first, there are different things that people should look at. It's a myopic kind of measure only. I get why it started, and we needed something, because the space is so hard. And it was years ago when this all started, but still.
It's so effectively TVL is it's like a trading indicator.
Yeah.
Right.
Yep.
That's how people treat it, and they kind of value the importance or the ability of a project to succeed on the back of TVL. But that's almost like looking at volatility in a credit fund, right? It goes straight up until it doesn't. So you'll have almost zero volatility, and then bam, you have massive volatility. So again, people just need to understand why they're looking at that indicator, and does it actually represent the things that are important for the potential investment that they want to do for that to succeed, right?
Yeah, I think it's absolutely fascinating whether it is the TVL dilemma there or just some of the other things that we're seeing in the TradFi space. We'll bring you back for some more in-depth insights and high-level conversation next week. Thanks, Arturo.
Thank you.